Alright, so let me highlight or explain what we refer to as a variance. What's a variance? A variance is simply the difference between an expected result and an actual result, or the difference between an expected standard and an actual standard. So this is the difference between expected, difference between expected and actual results, or actual performance, or actual standard. We have two types of variances, or two ways we analyze variances. We can either obtain a favorable variance, or so we either will have a favorable variance which we simply denote as F, or an unfavorable variance, what we refer to as an adverse variance, which we simply denote as A. So a favorable variance means it is a good variance. An unfavorable variance or an adverse variance means it is not a good what? Variance. For example, if it is a variance of selling price, your expected selling price was maybe 1500, but your actual selling price was who? 1800. This variance of 300, we are going to say it is what? Favorable. Why are you saying it is favorable? Because it is good when you had budgeted to sell at 1500, but you have actually sold at how much? 18. So therefore you have earned more. That means it is what? Favorable. If it is a variance of cost, maybe 1500 and still what? 1800. The difference there is 300. This will be an adverse variance because this is a cost, so it is an expenditure. You had budgeted to spend 1500, you actually spent 1800, therefore it is what? Adverse. It is adverse. Now, we will analyze various operational variances. Let me do away with this. The types of operational variances. We'll introduce our operational variances here. These variances will help us to reconcile between the actual profits and your budgeted what? Profits, or your actual performance with your budgeted performance. The first variance is your material variances. Your material variance. Then we will also have variances for labor. We'll have variances for overhead variance. And how is that? Your overhead variance, either you're going to have variable overheads, or fixed overheads. And lastly, number 4, you will have sales variances. So you will have the following types of what? Variances or operational variances. All right, so we are going to prepare the following operational variances: material variances, labor variances, variable overhead and fixed overhead variances. We are also going to prepare sales what? Variances, so that we can use this to reconcile between our actual and our what? Budgeted. So let's come here and prepare reconciliation statements. Reconciliation statements, which is what they required. So August 2023, they're saying part A 3, a reconciliation statement of actual and budgeted profit showing the variances. Showing the variances. Reconciliation statement. We want to tackle August 2023. 3A part 3. 3A part 3. Your actual profit. Your actual profit is 180,000. 180,000. Then you add or less. You add or less your variances. You add or less your variances. The first variance is what we refer to as material variances. So number 1, material variances, and your material variances are given are 2. You have number 1, material price variance, simply denoted as MPV. Now your material price variance is given by actual quantity standard price minus actual price. Where your actual quantity is actual quantity SP is your standard price. AP is your actual price. Your actual price of material. So it is you buying. So this SP means it is your standard buying price, and AP is your actual buying price of the material. Let's start with material A. Material A. Your actual quantity used is 19,100, or rather 19,000 actually. Your standard price per kg, they were saying, is 100 minus an actual price per kg. An actual price per kg, that is a the division of 2090 divide by 19,000. Divide by 19,000. Why? When you bought the 19,000 kgs, you incurred a cost of 90,000. So what was the price per kg? B, the actual quantity that was purchased is 10,100 liters. Your price per liter was 150 minus your actual price per liter, where you're going to take your actual cost of 14,000. You divide that by the actual liters that was purchased, which is 10,100. 10,100. So let's see. This should give you 190,000. 101,000. But we need to indicate whether it is favorable or adverse. We had budgeted to buy at 100 shillings per kg. We ended up buying at 100 and what? 10. Therefore, that means we have spent an extra amount. So that means that it is adverse. Here, you had budgeted to buy at 150. Instead of buying at 150, you ended up buying each liter at 140. Therefore, that is what? Favorable. That is favorable. So therefore, your material cost variance, or rather your material price variance, will simply be the difference between the adverse and the favorable. The adverse and the favorable. Why? Because you only add adverse and adverse, favorable and favorable. The adverse favorable, you do what? You subtract. The adverse favorable, you subtract. So our variance there is 89,000. That is what? Adverse. That is adverse, which you can simply say is 89. When we're writing here, we will write as 89, because remember, or we can just write this in total, 180,000. Instead of ignoring, let's just write in total so that it doesn't confuse you. 89,000, which is what? Adverse. The next variance is your material usage variance, which we simply denote as MUV. This is a variance that shows you the difference between what you budgeted to use and what you actually used. And the budgeted usage should be of actual production. So your material usage variance is given by standard price, standard quantity of actual production, minus actual quantity. The standard price you already know is SP. This is the standard quantity of actual production. Then AQ is the actual quantity. Of actual production. So this is the actual quantity used or consumed. So it is the actual quantity of actual production. We had two materials. A. Your standard price of A was 100. Your standard quantity of actual production, what do? You're going to take your standard quantity per unit. Let me highlight this here for you. The standard quantity is given by standard quantity per unit. You multiply by actual production. You multiply by actual what? Production, the standard quantity. Right, so we can start with material A. Your standard price is 100. Standard price is 100. your standard quantity of actual production, you're going to say that you are using 2 kgs per unit. You are using 2 kgs per unit. You multiply by an actual production of 9,000. So that means you actually your standard quantity of actual production is 18,000 kgs, but you actually used how many kgs? 19,000 kgs. Material B. Your standard price per kg is 100 per liter is 150. Your standard quantity of actual production, you are using 1 liter as per the standard. So your standard quantity per unit is 1 liter per unit. You multiply by an actual production of 9,000 units minus 10,100 minus 10,100 being the actual quantity you did what? Used. The actual quantity used. So let's do this. 18,000 minus 19,000 times 100. This is 100,000. 100,000. 9,000 minus 10,1 times 150. This will give you 165,000. 165,000. Then we need to analyze whether our variance is favorable or what? Adverse. Now, you had budgeted to use 18,000 kgs of material A. You ended up using 19,000. Therefore, that is adverse. You had budgeted to use 9,000 liters, but actually ended up using 10,100 liters. So therefore, that is what? Adverse. And then you add your adverse plus adverse. So therefore, your material usage variance is your 100 adverse plus 100 adverse will give you 265,000, which is what? Adverse. All right. But now, your material cost variance is a summation of material price variance plus material usage variance. The total of your price variance plus your usage variance, which here you're going to say 89,000 adverse plus 265,000 adverse. That should give you 354,000 adverse. The second variance is what we refer to, that is your material variance. So let's go to labor variance. The second variance is labor variances. Let me use a different color pen here. The first being your labor rate variance. Which you simply denote as LRV. Your labor rate variance is a variance that shows you the difference between the standard rate and the actual rate that was paid for the actual hours that were done what? Paid. So we say it is your actual hours paid for, your standard rate minus your actual rate. Where AH means actual hours, SR means standard rate per hour, AR is your actual rate per hour. Actual rate per hour. So the rate here is always in shillings, yeah? So the rate here should be in shillings per hour. So your actual rate should also be in shillings per who? Per hour. Okay. The actual hours that were paid for were 28,500. Your standard rate per hour, each hour was paid at 3 hours at 90 shillings, minus your actual rate per hour, which will be 36,000 divided by 28,500. Divided by 28,500. When you incurred the cost of labor, the actual cost was 36,000, and that is because you used how many hours? 28,000 hours and 500. 28 and 500. So this is 171,000, which is going to be adverse. The standard rate per hour is 90. The actual rate per hour is 96. So that means it is adverse. The next variance is your labor efficiency variance, which we simply denote as LEV. LEV, which is what? Which is your standard rate, your standard hours of actual production minus your actual hours. It shows you, or it is a variance that shows the difference between the standard hours of actual production and actual hours of actual production, but at the standard rate. Basically shows you the difference in hours that were worked, where your standard hours, we say it is standard hours of actual production. Your standard hours of actual production. AH is actual who? That way. Your standard hours of actual production, your standard hours of actual production, you're going to say it is your standard hour per unit, you multiply by actual who? Production, times actual production. So it is the standard hours of actual production, and your standard hours or 3 hours, or you can just get this variance, to say 3 hours. Your actual production was how many units? 9,000 units. But your actual hours were 28,500. Your standard rate per hour was how much? 90. So this will give you 135,000, which is what? Adverse. You had budgeted to use 27,000 labor hours. You actually used 28,500 and you still produce the same 9,000 units. Therefore, it is adverse. Then your labor cost variance is simply the summation of your what? Of your labor rate variance and your labor efficiency variance. It is the summation of your labor rate variance and your labor efficiency variance. 171,000 adverse plus 135,000 what? Adverse will give you an adverse of 306,000. Remember, we've said you add adverse, adverse, favorable, adverse, you subtract, favorable, favorable, you add. The next variance, that is our labor variances.